The most trusted investment in America is quietly dead, and almost nobody staring at their green portfolio has noticed. For 50 years, the answer was simple. Buy the S&P 500 and win. The chart only pointed one way, up and to the right. It felt like a law of nature, but that law just broke. The men who run Goldman Sachs put a number on it, and if they're right, the next 10 years look nothing like the last 10. By the end of this video, you'll know what killed it, why your account can keep rising while the thing underneath rots, and where the smart money is quietly moving instead. Stick around. The twist hides inside a number almost no investor has ever heard. Alright, I'm Sargon, and this is Strategy State, the channel where we take the money advice everyone treats as gospel, and we pressure test it until it either holds or cracks. Today, we put the holiest rule in investing on the table. Just buy the S&P 500. Let's find out why that rule is quietly falling apart in 2026, and what actually replaces it. First, what the S&P 500 actually is. It's a basket of 500 of the biggest public companies in America. Buy one fund, own a slice of all of them. For decades, it was the ultimate lazy genius move. Instant diversification, tiny fees, and returns that beat almost every hedge fund on earth. Warren Buffett himself said most people should just put their money there and never touch it. So if it's that good, why am I telling you it's dead? Here's the first crack. And it's a big one. In late 2024, Goldman Sachs published a forecast that landed like a bucket of ice water. Their strategy team said the S&P 500 will return just 3% a year for the next 10 years. 3. Not the 13% a year investors got over the last decade. That ranks in the bottom 10% of every 10-year stretch since 1930. Let that sink in. The bank that prints market forecasts for a living is telling you the next decade could pay you less than a savings account, and they put a 72% probability that stocks lose to boring old bonds. But a forecast is just an opinion. So what's the hard evidence underneath it? That's where this gets uncomfortable. It comes down to one word: price. There's a famous gauge called the CAPE ratio that measures how expensive stocks are versus their long-term earnings. Right now, it sits around 38, the 97th percentile in history. It's only been this high twice before, right before the 1929 crash and at the peak of the dot-com bubble in 2000. You know how both of those stories ended. Now, high prices don't guarantee a crash tomorrow. Markets can stay expensive for years. But history is brutally clear on one thing. The more you pay going in, the less you take out over the next decade. And yet, this still isn't the real reason the S&P 500 is dead. The real reason is hiding in plain sight. Here it is. You think you own 500 companies? You don't. 7 stocks: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, now make up roughly a third of the entire index. The nickname is the Magnificent Seven. 8 years ago, these same names were about 12% of the index. Today, 7 companies out of 500 drive a third of your money. So when you brag that you're diversified across 500 companies, you're really making one giant bet on a handful of tech giants, whether you meant to or not. And here's the number almost no investor has ever heard, the one I teased at the start. It measures how concentrated you truly are. Brace yourself. Analysts calculate something called the effective number of stocks. It strips away the illusion and asks, how many companies is your index really acting like? The answer for the S&P 500 right now is about 54. 54. You hold 500 names on paper, but your risk behaves as if you own roughly 50. 90% of that famous diversification is a mirage. That's the trap. The S&P 500 sold itself as the safest, most diversified bet in the world, and it quietly became one of the most concentrated it's been in over 50 years. When the top 10 stocks are worth around 40% of the whole index, a stumble in just those names can drag everything down with them. But before you panic and sell everything, the story flips here. Because the S&P 500 is dead doesn't mean the stock market is dead. It means one specific version of it, the top-heavy, tech-stuffed, cap-weighted machine, is running out of road. And the moment that machine slowed, money didn't vanish. It started flowing somewhere else. In 2025, for the first time in years, the rest of the world woke up. The numbers are staggering. While the S&P 500 rose about 16% in 2025, the index of international stocks outside the US jumped over 29%, nearly double. South Korea's market soared around 76%, its best year since 1999. Europe roared back on defense spending. For the first time in half a decade, betting only on America was the losing move. Now, why would money suddenly flee the greatest stock market on earth? A lot of it comes down to one thing hiding in the background of every headline: the currency itself. In 2025, the dollar fell almost 10%, its worst year since 2017. Wall Street even coined a phrase for the shift: the sell America trade. When the dollar drops, every foreign investment automatically becomes worth more back home. The tide that lifted America for a decade started running the other way. And it wasn't just foreign stocks. One ancient, boring asset had its best run in decades, and I bet you can already guess what it is. This is the part where the people who called the S&P 500 dead started quietly winning. Gold. The asset your grandfather loved and your finance bro laughed at. It smashed through $4,000 an ounce in 2025 and, over 12 months, more than doubled the return of the S&P 500. Central banks around the world were quietly hoarding it, hedging against a shakier dollar. While retail investors argued about tech, the oldest money on earth was outrunning the newest. There's even a fix hiding inside the S&P 500 itself. It's called the equal weight version. Instead of letting 7 giants dominate, it gives all 500 companies the same slice. In it, those same 7 megacaps go from around 30% of your money down to about 1.5%. Same 500 companies, a completely different, far more balanced bet. So, let me connect the dots I promised at the very start. The old rule, dump everything into the S&P 500 and coast, worked beautifully in a world that no longer exists. High prices, extreme concentration, and a low forecast just quietly killed the easy version of that trade. But the death of easy is not the death of investing. Here's the balanced truth, because I'm not here to sell you doom. Those 7 giants are wildly profitable. They actually earn the money behind their size, which is exactly what the dot-com darlings never did. The market may not crash. It may simply grind out those thin returns Goldman warned about. Boring, not catastrophic. That distinction is everything. So what do you actually do with all this? You stop treating one index as a magic money button. You spread the bet. A slice of international, a slice of that equal weight version, maybe a little of the oldest hedge there is. You stop confusing what worked for the last decade with what works for the next one. Diversification, the real kind, is boring. It's also how you survive. One last thing to keep you honest. Every single one of these forecasts could be wrong. Goldman themselves have missed before, and plenty of sharp investors argue America's giants still grow faster than anyone. Nobody knows the future. The point was never to predict it. The point is to stop betting your entire retirement on a single story you were told was guaranteed. So, Is the S&P 500 really dead? Here's the honest answer to my own riddle. The ticker isn't dead. It'll keep printing green days. What died is the fantasy, the belief that one lazy purchase guarantees you riches with zero thought. And here's the funny part. The index called 500 stocks spent years quietly behaving like 50, and nobody read the label. Turns out, the riskiest thing you can own is a bet you never realized you were making. If this changed how you see your own portfolio, do me a favor, smash subscribe, hit that like, and tell me in the comments, are you sticking with the S&P 500 or are you finally spreading out? I read every one. This is Strategy State. I'm Sargon, and I'll see you in the next one. Keep thinking for yourself out there.